the actual result for the period, people will have seen that, but across the board it was exactly, in fact, it was slightly above where we expected it to be on our budgets. So whichever segment you look at, and that goes across whether it's the trade business, the specialist wholesale, the New Zealand, or what used to be called Halaby, but Bapcor New Zealand, and also the retail. If you were to pick one out, retail would be the one that looks slightly soft for those who don't get in the detail, but it's where we expected it to be because it does absorb about $500,000 of cost of rolling out new stores and the greenfield stores, which will continue there at those sorts of levels or above in the next year until we get to a point, as we do with the trade stores, where you're cycling over, so it's built into the base. So where we're changing from being franchise stores, and we're growing the network as company-owned stores. So you will see that negative impact, but within a couple of years you start to see it, the results of it. So it's as we expected to see it, and I think it's just where some people have missed that would be the case. When you look at each of the segments, each of them is performing extremely well, whichever one you look at. We had same-store sales growth, 3.4% in trade. The key there is that that doesn't have any or minimal price in it. So if you're comparing it to prior periods, we did have a price increase, cost recovery in January. So we expect to see the second 6 months will be slightly above that, which is still within our 3 to 4% guidance range overall. Specialist wholesale is going pretty well, and New Zealand, as Joe said, is just New Zealand stroke the Halaby acquisition's it has got so much more potential in it than we thought. So when we roll forward, the key to this business, when it comes down to it, is really basically two key things. One is the continued store rollout, or site rollout. So in the case of the Australian trade business, we're at 164 stores. Our target's to get to 200 over the next few years. But we think we'll be revising that upwards slightly, maybe to 210 to 220 before the end of this year. So because we're redoing all the work about where mechanics are and the profiles. So that business will continue. The retail, as we said, we're going from 124 Autobarn stores to 200. Specialist wholesale is all about pushing volume from there into the trade and retail businesses. And New Zealand's got a whole lot of things, whether you look at store rollouts, range expansion, Capricorn. There's a whole lot of incentives we're going to put in place. Just all the things that we've done in Burson that prove that they work in this industry. So there's there is quite a 5-year path there for us to continue the growth. So those that say, we'll run out of things to do, they really don't know what they're talking about, or else they should come and work for us and find out how much there is to do. And there is plenty going on. The big key, other than store rollouts, is intercompany sales or own brand, which is a key thing. And as we grow our own brand, that's what will drive the business. So we've got a couple of key things we're working on, but there's a list of them. So developing own brand, the margin benefits you get will roll out over the next few years. And you've got within that, at the moment, we're 11.5% EBITDA to sales at group, and we'll see that go to between 12.5 and 13 over the next 5 years. So it's roughly 20 to 30 basis points a year improvement, plus you're getting the top line. So you're getting that double impact on the bottom line profit. We're quite comfortable with that overall. One of the things, just to point out if anyone's looking at it, that most have missed is that when we do more intercompany sales, it doesn't actually show up. It shows in each of the businesses. So it's going from specialist wholesale into one of the others. It shows as a sale at normal margin, but it's eliminated at the group level. So you've got to sort of account for that. Otherwise, it looks like the margin's going nowhere by individual business, but group does go up. So there's just a couple of little things in there for people to be wary of. The other couple of things we've got coming down track, DC Evolution, as we've called it, which is really taking all our distribution centres in Melbourne and Brisbane, which we've got about 8 or 9 in each, into one, and it'll be a new DC, so you won't have sort of the pains of trying to retrofit something. And that will cut out, not only it'll improve operating costs, it'll improve availability, but also importantly, it will reduce inventory, because instead of holding inventory in 3 different places, you're going to hold it in one. So you'll be able to reduce what you have. And that's a sort of 3 to 5 year project. And the other thing that we've got, in May this year, we expect to open our first store in Thailand. And before the end of the calendar year, we'll have about 5 or 6 stores, plus a sourcing office. So it'll help in the sourcing side. And that's I'll call it the litmus test, put your toe in the water. We've got 2 joint venture partners that are local Thai, and we're the majority owner. We appoint the CEO of that business, and we chair the board, and we've got effective control of the business. So, and it's a couple of million, $2.5 to $3 million investment for us. Most of that's inventory, so if it doesn't work, we bring it back. If it does work, we've got a fairly substantial rollout plan for Thailand, and then we would move into neighbouring Southeast Asian countries and do exactly the same concept, test that it works, and go forward. And there are no other competitors of our nature in that market. So this is the evolution of where those markets are at. They're about 30 or 35 years behind the evolution in Australia and the US. So it's a picture. We've got runway ahead of us. We don't expect some of those things to deliver for between 3 and 5 years, but we're looking at both now, which we've got a lot of projects underway to deliver synergies from Halliby and other acquisitions and the underlying growth. And we've also got some longer term projects underway that won't benefit now, but they will in the 3 to 5 year time frame.